Awesome. Welcome, everyone. To forecasts aren't just for meteorologists. Every business needs one. A couple of housekeeping items for today. Our playback of the full webinar will be on our website at arenacfo.com. We'll also have example financial models for you to download for free on our website at arenacfo.com. And you can get access to a financial professional for as little as 2 hours on the website as well if you need an assist. And detailed steps on putting one together as well will be on our website at arenacfo.com after the webinar. Also, just a couple other housekeeping items. Since it's a webinar, we have both a chat window and a Q&A. Feel free to use the chat if you're having any trouble hearing or seeing the slides or myself. And use the Q&A to post up questions or comments that you'd like either a double click on or you have a question in particular you'd like asked. The format of the webinar today is section 1 will be around learning why financial forecasts are important and why you need to put one in place for your business. The second section will be on building your revenue forecast, and the third section will be on building your expense section of your forecast. So as you think about questions you might have, posting them in each of those sections would be helpful. All right, I say we dive right in. Besides, one of the reasons why financial forecasts don't exist in businesses is because everybody doesn't have time. So let's get going. I'm Heather Twasson, the CEO of Arena. We are CFO services simplified for businesses. We really believe that businesses across the U.S. can thrive and be more successful if they are planful around their finances, which is why we built the company. Feel free to learn more about us at arenacfo.com. So I thought we'd start off with a customer story. This is Mike Week. Mike Week is a good friend of mine. He also has built a landscaping company in the area I live in. He started this company out by building a brand for himself at the local Little League fields where he offered his services for free, and then built a customer base there that has grown his company over the last 30 years to be multiple products. So the reason why I wanted to highlight Mike today is he has an interesting business model. He sells a number of different types of services and products to his customer base. So it hopefully this example resonates with most of you out there and can either apply the service-based component of his business model or the product-based component of his business model to the forecasting lesson that we'll have today. So Mike has a couple of things. He started off mowing grasses and really just doing lawn care. And what that does for a financial forecast is it builds in repetitive revenue for your business because you typically bill your clients on a monthly basis. You could bill as the service is performed as well, but Mike has decided to bill on a monthly basis to all of his clients. The other aspect of his business that he built on over time is landscaping, as you can see from his website picture. This is more of a one and done activity and is not so evenly spread as you think about bringing in revenue for your business over the course of a calendar year. The next thing he built into his business model is hardscaping. And that's kind of the stonework you see on his website here. And he does an excellent job at it. And this is also a one and done activity. The other interesting thing about hardscaping, it has a large upfront cost. He has to buy the materials ahead of time. It's not just labor intensive. Then over time, Mike has added on to his business snow removal. During the off season, he likes to keep his employees employed, and he's added on snow removal and some other type of groundskeeping work done in the wintertime. Where we're located, we have all 4 seasons, so snow is unpredictable as well. So that creates another challenge for his financial forecast as he thinks about when he's going to be receiving money from his customers. On the flip side of that, his expenses are very disconnected to the cycle that his revenue comes in at. He has one core principle for his company. He pays all his people every single Friday, and they really like it. It is something that he has prided himself with over the course of his 30 years and kept his employees really happy. The dilemma with this is that he doesn't always get paid every Friday himself. So he needs to account for this disconnect in the cycle time between when his clients pay him and when he pays his employees. He also has a number of other things he has to take into account as he thinks about his expenses. Equipment, the trucks that go to the site, the lawn mowing equipment itself, supplies such as the hardscaping materials, fertilizer, etc., and maintenance of all of those things. Some of those things you can forecast and sometimes you can't. So today we thought this example would be great as we start to dive into a little bit more around why a financial forecast is so important to your business, whether you have a service or a product-based business. %90 of businesses in the United States do not have a financial forecast. We learned this by polling over 450 businesses across the United States a couple of years ago. Now that was pre-pandemic. So my hope is that that number has changed a lot since that time. And folks have taken the time to really think about how they are planning to make money in the future and what it's going to cost them to make it as they think about both their revenue forecast and their expense forecast. At Arena, we really believe that this is one of the reasons why 50% of businesses fail by their 5th year. 50% of businesses have failed by their 5th year for decades. This is a stat that comes out of the Small Business Administration. It's pretty astounding if you think about it. A lot of those businesses cite cash flow as their main reason why they have failed, 82% to be exact. And we believe that 90% of those businesses that don't have a financial forecast fall in that bucket. So we're here today to teach you about a do-it-yourself method, an assisted method, or a full service method to building a financial forecast for your business and creating a discipline around it that really sets your business up for success in the future. I just enabled the chat. I believe it was disabled. If you think about having your bookkeeper or your accountant that help manage your finances for your business, note that they often are looking in arrears. They're looking at what you did in the past as they do perform their work. What a financial forecast or a CFO does for your business is they look forward. They help you strategically plan and anticipate things that might come up that you need to make sure you have the ability to either fund if there's going to be a deficit, or you have surplus cash that you might want to spend. Let's talk about why a financial forecast is important for every business. Other names for financial forecasts out there are financial plans. Some people just use the term budget, although budget tends to be more in reference to the expenses associated with the business. Right, I think I finally fixed the chat. You can talk about P&L expectations. What are your expectations for growth? There are many terms that describe what a forecast is for your business. But basically what a forecast is your anticipated revenue and your anticipated expenses needed to achieve that revenue figure. There are a couple of reasons why this is super important. And I think oftentimes businesses forego a forecast because they think it's just for themselves. Well, it's not. And let me tell you a couple of examples on why. Outside your company, a forecast is very important to build confidence in your banking and lending partners. Oftentimes, forecasts are required when you seek out a loan. They're definitely required if you seek out any capital that's funded by the SBA or guaranteed by the SBA. So really think about having a financial forecast in anticipation of any cash needs. The other thing is when we went through PPP or government assisted funding during the pandemic, a piece of that was submitting your forecast to get you the max amount of financial assistance from the government that you could get. So it's important to also have your forecast at the ready for any time a crisis could occur. It's also important to have a forecast in place to give confidence to any new employees or investors that could be coming into your business, and have confidence that you are a well-managed institution or company. Inside your business, it's important to set clear goals and be transparent in what is expected of your team. Having your team know how much money you anticipate making, how many customers are the target for the year, as well as the expenses they have to achieve those targets is important. It also holds you accountable. Having a forecast also can create a discipline by which you manage. You can basically assess your actuals versus your forecast on a monthly basis to see how you're doing. And at Arena, we recommend that. The biggest mistakes businesses can make, or most seen when people create a financial forecast, are these. There are three. They create a forecast that's way too complex. It's hard to maintain. It often gets out of date. The business shifts and it's irrelevant. Keep your forecast simple. Complexity only means that you will have more and more maintenance to it over time. The second thing that on why forecasts often fail, or the biggest mistakes in putting together, is not incorporating it into your regular business routine. And regular visiting of your financial forecast in relation to your actuals and any metrics that you put in place for your business is important. At Arena, we recommend you do this monthly. And the third reason why and biggest mistakes around creating a financial forecast is putting expenses down on a sheet of paper before you put your revenue down. It's completely inverse of how you think about a household budget. You need to think about how much money you want to make in the calendar year, and then start to detail out how much it's going to cost you to make it. When you're in a household situation and you're thinking about your regular home life and putting a budget together, your income coming into your household is typically fixed. Therefore, the only variable that is within your control are your expenses. That's not the case when you own a business. The top end of a revenue target is unending. So thinking about your revenue first is super important. Now let's talk about the how. How to build your revenue forecast. Things to take into account, then we'll dive into the actual orchestration of a spreadsheet here in a minute. Our prior performance. How have you grown your company before? What areas of your calendar year are more successful than others? Do you have any new ambitions? Are there new lines of product that you want to start to sell, or service you want to start to sell? Are there headwinds out there? Do you have a new competitor in town? Are there economic troubles ahead? Do you anticipate not having access to a line of credit in the future? Do you need to take that into account? When you think about building your revenue forecast, think about these things. Also, when you think about the fidelity or the precision you are going to put in each cell, you do not have to be to the penny precise. The more precise you are, the better. But hey, putting something down versus not having anything down at all is more important. Let's walk through an Excel example of a simplistic revenue forecast. So here, the first thing you should think about is how much money you want to make within a calendar year. Let's say our goal is 375,000. Well, we're starting the year out with 25 customers, and we sell a product that costs $1,000 each. And let's anticipate growing our customer base. We'll get one new customer a month, just for simplicity's sake. Well, let's see, what is that going to give us? It's probably not going to get us all the way up to 375,000. But if we calculate that out, we can see that's close, around 366,000. So let's go with that without having to adjust any of the customers. Now, One thing that I would call out here is this is a super simplistic view, right? And it is very general. You see, we're not using dollars, specific dollars or cents as we put a forecast together. It's an expectation. It's a guess. There are a lot of assumptions that go into how you build out a forecast. The other thing here is once you have this baseline, then start to add the specifics, nuances of your business. For instance, if you gain more customers during the summer months, adjust it accordingly. If you have a campaign that you know or a sale that you know is going to hit in the month of November of each year, adjust it accordingly. If you know that you sell products and one customer might buy multiple products, you can begin to break this revenue figure down by product and service sold. And it is recommended that you do that over time. And we'll talk about that a little bit at the end on why it's important to have a characteristic of how much each product or service costs you to make and how much you sell it for. And as you think about layering all of that in, you just think about it like making a lasagna, right? You have the bottom of the pasta, then you add some meat and sauce and cheese and a lot of cheese. I love cheese. And then some more pasta on the top. And it really starts to build in different cells within your sheet that then add up to your total revenue figure expectation for the year. Now, moving into how to build an expense forecast for your business. Once you've already built your revenue forecast, it's important that you then layer in your expenses. Most people start with expenses as they think about managing their forecast for the future, and because they seem constrained by the amount of money they have in their bank account. In a business forecast, you need to think about your revenue targets first, and you might need to adjust them over time if you don't hit them or if you overachieve them. And that should also adjust your expense figures. So as you think about building your expense forecast, think about these things. Think about your prior performance. Have you overestimated expenses or underestimated them? What are your marketing drivers? Do you have to put money into marketing and advertise your product or service 2 or 3 months ahead of the time when you get your first dollar of revenue from that investment? Also, think about your employee drivers. At what point in your company growth does it make sense to either hire a new employee or consider having to let someone go? So think about your employee drivers as well. Also, do you want to think about adding bonuses or increases to their salary? That is also something that should impact your expense forecast and how you think about it. So let's walk through this one in a little bit of detail. For expenses, oftentimes thinking about your past performance is important. As we talked about, having different categories within your expenses is also important as you think about when they are more evenly distributed throughout the year and when they are lumpy or seasonal. As you can see in marketing here, in this example, we put together some upfront expenditure in marketing at the beginning of the year and then only on a quarterly basis thereafter. Payroll, we have set at $15,000 to get started for the year, but we anticipate either hiring another employee or increasing salary. Equipment is evenly distributed throughout the year, and inventory has a lumpy character to it. And it has a spike in March as we anticipate expenses due to the spring cleaning season for, say, a landscaping company. After you've done this, add a stress scenario or two. Let's think about the pandemic and how that impacted landscaping. Everyone started doing their own gardening, so that impacted businesses like Mike's. Making sure you think about that and what impacts it might have on a month-to-month basis for your company is important. In this scenario, as you can see, it impacted this business significantly. And there are months where they're in the hole. They basically don't have enough revenue to sustain the expenses that they have. and it has an overall impact to the annual view of, $60,000, which is enormous. But as you think about that in the context of a year in entirety, they're still made money at the end of the day. Other metrics you can think about adding are profit margin and profit margin by product. I always recommend these metrics because they're oftentimes are signals to you that you might need to increase your costs. I'm going to pause it here and see if we've got any questions in the chat window. Awesome. Yes, the presentation will be online at our arenacfo.com website. If you have any questions as far as any details on revenue or expenses, please feel free to put them up in the chat window. I think something that that has come up in the past is these figures on let me just go back to 90% of businesses do not have a financial forecast. There are a number of businesses out there that have a budget. And I'd say that that in my experience in working with businesses, that the businesses that just have a budget and not a revenue projection or ambition to grow their revenue targets in any way, they are slower growth companies in general. And when you anchor your decision making around building a revenue forecast first, more often than not, you're gonna get closer to your revenue targets. If you don't think about your revenue targets at all, and you just think about your budget and expenses, you're basically setting yourself up for flat growth. Let me stop my share and see if there are any other questions.
Heather, there's a question in the chat for you.
Okay. All right, the question is, expenses and forecasts are very sensitive to levels of inflation during times such as we're in. What source of inflation in general do you use for expenses, including labor? It certainly depends what business line you're in and how frequently you are onboarding new employees and not, and if they're salary or hourly. I do notice that in the hourly employee realm of labor, that increases in salary happen faster in an inflationary environment. So revisiting them on at least a quarterly basis and taking into account what is happening in the inflationary environment. And as you can see, rates going up, those are good percentage points to kind of take as a baseline for that. So that's one piece of the labor market that is more hourly based in the way they are paid. In the salary base, I noticed that they're less frequently visited, but when you do shift salary bands within a salary based workforce, they tend to shift in higher increments on a slower periodic basis, on more of an annual basis. Another question in the chat. Is there any software that you can recommend to assist with creating a financial projection? Most people use Excel or Sheets, I'll say, to get started. And there are many other more sophisticated tools, but my total recommendation is to start simple and start, as simple as the Excel sheet we just showed on the screen. We'll also put that Excel sheet up for anyone to download for free on our website. It's super simplistic in the way it's built. And if you have any needs to build that out with more sophistication, we can certainly help with that. The other more sophisticated tools out there, in your QuickBooks, you can actually load in a forecast and compare that to your actuals each month. That is another thing that is available through your accounting software. And at Arena, we have our own proprietary solutions that can help you build a forecast. and match that up against your actuals, as well as any key performance indicators like profit margins, customer satisfaction, and increases in sales that you might want to track throughout the year. Another question in the chat. Does it make sense to create goals and probably milestones that you know what direction to go for the revenue expectations? For example, hiring new employees or purchasing vehicles, etc. Yes, I believe that once you create a financial forecast and create some triggers in there to know when it's a good time to hire or spend more money, and that will be in your top line as well as your profit margin and basically what your net income is. And so what I mean by that, let me break that down a little bit. So as you think about the growth plan that we just described here, let me just pull up the expense one we had up on the screen. As we think about this, and we think about payroll here, I actually had an increase here in April. And so I had for the example's sake, I had a trigger point of once I hit 28 customers, I'm going to need another employee. And that trigger point is going to be different for every business, for certain. The couple of metrics I would put in place to know is a consistent profit margin. And profit margin, meaning what is the margin between how much revenue you make and expenses you pay out the door. I would probably have that tracked on a rolling 3-month basis. And once you get to a point where you're comfortable with that, and you're starting to see a very large profit margin, making sure you're still going to be a profitable organization with hiring that new employee, that's when I would make that consideration. There are much more detailed ways and metrics that you can put in place for your specific business. So feel free to reach out to me or anyone on the Arena team if you need a key performance indicator that's meant for your business. So what would happen if you need an assist in any of the KPIs, as far as putting your forecast together, putting your KPIs or key performance indicators together? You can do this yourself. There are a number of also some online tools that I highly recommend. We'll also put those up on the website as well as links out to some reputable sources out there that are logical, simplistic measurement tools for putting KPIs together. There are some specific by industry as well. If you have a specific industry that you're looking to get some more peer insights into and key performance indicators that are specific to your business, let us know. We're happy to load those up on the website as well. And so we'll definitely put some links out there for that. The other thing is our CFOs at Arena are industry specific CFOs. So what they do is they face off with your business, and they also face off with other businesses like yours. So you actually get the broader insights of your kind of community within your segment. So that is an advantage of having someone that is a fractional CFO for your business that also faces off with other businesses like yours. They could be in or outside of your geography. They're not necessarily direct competitors. Another question in the chat. Let's see. Do you provide services to startup companies, and are you familiar with the home health industry? Yes, we provide services to startup companies from the time they are putting their pitch deck together and either getting a loan for their business, starting it off using personal funds, or seeking capital from venture capitalists. Our CFOs are trained in that area as well, and they will help pull together financial forecasts and projections for each of those purposes, as well as putting together your overall business plan, which has a component of that being a financial forecast. We also do have industry expertise in healthcare and home health in particular. We do have a number of clients that have home healthcare agencies and have experts that face off to them as well. So feel free to reach out to us. We're happy to put you in touch with available CFOs in your specific industry. And when we can, we put them in your geography as well. Any other questions? Another question in the chat is, does Arena have the fee structure according to the services you provide? Yes, we do. If you go on our website, we would typically put a quote together for every client. But we've got some general buckets of services by cost on our website at arenacfo.com. Well, thanks for coming, everyone. A special thank you to Don, Richard, Akivia, and Mercy for helping